All right. 6,882. That is the closing print on the SPX. We're down 0.5% on the benchmark. But honestly, if you were just staring at the S&P 500 today, you missed the actual movie.
You missed the violence. The headline number is, it's sleepwalking. But under the surface, it was a crime scene in the growth sector.
That's what we need to break down immediately, because looking at the board, we have a tale of two completely different markets. You've got the Nasdaq closing at 22,904. That is a 1.5% haircut. A serious red day.
But the pain point, that's where all the leverage was, and that's where the liquidation happened.
And yet, in what feels like a completely alternate reality, you have the Dow Jones, closed at 49,501. Up 0.5%?
Right.
It's almost disorienting. You look at one screen, the world is ending. You look at the other, we're popping champagne.
It's the classic divergent trend day. And for traders, these are the most dangerous days to navigate because your eyes, they deceive you. You see green on the Dow, maybe a headline about an intraday high, and you think, okay, everything is fine.
Everything's fine.
Meanwhile, the floorboards are giving way in the technology sector. You have industrials holding up the ceiling while tech is just breaking the foundation.
And we can't ignore the elephant in the room pushing on those floorboards. Yields, we saw the 10-year Treasury creeping up again today.
That is the pressure valve. When the 10-year starts ticking up, it acts like gravity on those high-duration growth stocks, the tech names that rely on future earnings. But look at what else it hit today.
Utilities.
Utility.
Right, they were a big laggard, down almost a full percent, 0.9%.
Which makes perfect sense if you understand the mechanism. Utilities are your bond proxies. They're safe, they're slow, they pay a dividend. But when the yield on a risk-free treasury creeps up, investors stop chasing a 3% dividend in a utility stock.
Why bother?
Why bother? They can get risk-free yield somewhere else. It's an automatic sell program. The algos see the 10-year tick up, and they just dump utilities instantly.
But then you flip the coin, and you see financials leading the clubhouse, up 1.1%. Is this just the inverse of the tech trade, or is there something real there?
It's partly the rotation, sure, but it's also fundamental. The credit data looks solid today.
Yeah.
Bank margins are resilient. The market is rewarding, real economy stocks. But I want to circle back to that divergence you mentioned.
Yeah.
A 0.5% drop in the SPX completely masks the rotation. This wasn't money leaving the casino. It was money just moving to a different table.
Okay, let's dig into that rotation. Because usually when the Nasdaq takes a 1.5% nosedive, the sentiment just screams panic. It feels like the world is ending today. The sentiment felt oddly neutral.
It's what I'd call aggressive neutrality.
Yeah.
This is institutional repositioning. And we have to talk about the head fake this morning because I guarantee you some listeners got caught in that.
Oh, absolutely. If you were watching the Dow in the first hour, we printed 49,400 plus. We hit an all-time high intraday.
That looked like breakout.
It looked like a breakout. I know a lot of retail traders who probably smashed the buy button right there thinking the rally was expanding.
And they walked right into a buzzsaw. That early strength wasn't a buy signal. It was an exhaustion signal. It was a classic bull trap.
Explain the mechanics of that trap. I mean, who is setting it?
The big desks. The institutional liquidity providers. They see the retail excitement over the Dow high, and they use that buying pressure, that liquidity, to unload their tech exposure. They were selling the semiconductor rep to buy the industrial dip.
So it's a distribution tactic.
A pure distribution tactic. They aren't going to cash. They are hiding. They're hiding in defensives and metals.
We saw that so clearly with Amgen.
The safe haven of the day.
I mean, while NVIDIA and the entire semi-complex are bleeding out, Amgen surges 7%. That's a massive move for a stock that usually moves like a tortoise.
It's a bullish reversal for Amgen specifically, sure. But if you zoom out, it tells you the big money is parking cash. They are scared of the high multiple tech names, so they're buying these old guard pillars to hold up the index. Amgen was basically the only thing preventing the S&P from collapsing today.
Well, if Amgen was the pillar, AMD was the wrecking ball.
A total capitulation.
Down 17%. And this is what's going to confuse the average listener. And frankly, it's frustrating. AMD beat earnings. They raised guidance. In any normal market, that stock is up 5% pre-market. Instead, it got taken out back and shot. Explain that logic.
This is the most critical lesson of 2026 so far. And if you take nothing else away from this, take this. Context is everything. When a stock is priced for perfection, a beat and a raise is the bare minimum requirement just to stay flat.
So the good news was already baked in.
Baked in, frosted, and served. The expectations for AI revenue are so hyperinflated that the market looked at AMD's numbers and said, that's it. They needed a blowout to justify the multiple. They didn't get it.
It feels like we're in the show me phase. The honeymoon is over.
Precisely. Investors are done with promises. They're demanding profitability now. And structurally, the chart on AMD is just broken. It didn't just drop. It dragged the entire semiconductor complex Broadcom Micron down with it.
It wasn't just chips, though. The software fade was nasty. We saw LegalZoom down 20%, Thomson Reuters down 15%.
That's the second-day fade.
Yeah.
And that is a very specific and a very bearish pattern.
Okay, walk us through that. What is a second-day fade?
So stock takes a big hit. The next morning, day two, it tries to rally. The bulls step in to buy the dip. But in a second-day fade, that morning rally fails. Immediately, the stock rolls over and makes new lows.
Which tells you what about the buyers?
It tells you they are weak. It means every pop is being sold into. The supply is just overwhelming the demand. The software sector is screaming that the easy money is gone.
So we have tech capitulating, financials holding up, and this massive rotation happening under the hood. I want to verify this with the internals. Was this just retail panic selling, or were the institutions actually moving weight?
You have to look at the volume. That's the lie detector test.
S&P 500 consolidated volume came in at 5.8 million shares. That is roughly 15% above the 30-day average.
That is high conviction. That confirms the move.
See, that stands out to me. If we were down 1.5% on light volume, I'd say, okay, buyers are just on strike. They went to lunch. But 15% above average.
That means supply hit the market. Real supply. This wasn't retail selling 50 shares of NVIDIA from their phone app. This was surgical institutional distribution. They were unloading semiconductor and software verticals into that early morning strength we talked about.
And the breadth confirms it. You call this the gilded cage.
It's a shiny exterior with a trapped interior. Look at the advanced decline ratio. It finished at 1 to 2.5. So for every stock that went up, 2.5 went down.
But here is the smoking gun for me. The S&P 500, the index everyone watches on TV, it touched a new 52-week high intraday.
Because it's market cap weighted.
Yeah.
The mega caps, the Googles and Apples of the world, they hide the damage. They distort the picture.
But look at the RSP. That's the equal weight ETF.
Right. For the listener who doesn't track this, RSP treats a massive company like NVIDIA the same as a smaller company like News Corp. Every stock gets the same influence. And the RSP closed red.
So the average stock is down while the headline index hits a high. That is a textbook negative divergence.
It is, and history suggests that when you see new highs in the index that are unconfirmed by the average stock, the rally is just running out of oxygen. It's a hostage situation led by 5 or 6 tickers. Usually this resolves with a mean reversion of 3 to 5% within the next 2 weeks.
Basically, the engine room is smoking even if the paint job looks shiny. Now, one more data point before we look at tomorrow. The VIX.
The fear gauge.
We closed down on the SPX, but the Dow was green. Usually on a mixed day, volatility gets crushed. But the VIX ticked up today. Closed at 15.4, up 3.2%.
That's significant. It's the volatility floor rising. Implied volatility isn't crushing because traders are buying weekend insurance.
Buying insurance, you mean puts?
Exactly, puts on the index.
Yeah.
And specifically, they're doing it ahead of the non-farm payrolls on Friday.
The jobs report.
The market is staying bid on protection. Institutional players are terrified of a downside surprise in the labor data. They're hedging their bets, which keeps that VIX elevated even when the Dow is rallying.
Which brings us to the so what? We know the setup. What matters for tomorrow, Thursday morning, the catalyst is already here.
Alphabet.
GOGL just dropped earnings in the after hours, and frankly, it looks good.
It was a solid print.
$2.82 a share versus $2.57 expected, a solid beat. Stocks up in the after hours. So here's the bull case. Doesn't this save us? Doesn't a beat from Google put a floor under the Nasdaq for tomorrow open?
You would think so. I mean, a year ago, I would have said yes, absolutely.
Yeah.
But today, I'm skeptical.
Why? It's good news. And Google is a behemoth. If they rally, the Nasdaq rallies.
Not necessarily. Look at the price action today. We just had a divergent trend day where the Nasdaq breached its 100-day moving average. That is a major technical breach. The chart damage is done.
So you think the technicals outweigh the fundamentals here, even a solid earnings beat from Google?
In the short term, yes. Historically, when you have back-to-back sell-offs of this magnitude in tech, the probability of downside continuation is about 62%. The market mood has shifted. If tech doesn't catch a massive bid in the first 30 minutes tomorrow, even with the Google news, that rotation accelerates.
You think they might sell the Google news?
I think they might use the Google liquidity to sell everything else. The market ignored the AMD beat. Why wouldn't it ignore the Google beat if the macro narrative is shifting to risk off?
Speaking of macro, we have data at 8:30 a.m., initial claims.
The wild card. If we see any hint of labor market weakness, any crack in the dam, the soft landing narrative gets shaky. That puts yields back in focus and could actually help the defensive rotation we talked about.
Let's talk levels. For the traders listening, we are staring at a very specific number on the SPX.
The gamma wall, 6,850.
We closed at 6,882. We are dangerously close. Now, I want to slow down here because this is crucial. For the listener who isn't glued to options flow every day, explain the gamma wall. We hear it all the time. Why does breaking 6,850 trigger a sell-off?
Okay, so think of the market makers, the dealers, as the house in a casino. Their job is to stay neutral. They don't want to bet on the market direction. They just facilitate trades.
Right, they just want the fees.
Exactly. Now, based on where all the options are positioned, above 6,850, the dealers are in a spot where if the market drops, they have to buy futures to balance their books. They act as a cushion. They dampen the volatility.
So above 6,850, the dealers are basically safety nets.
Correct. But 6,850 is the flip point. If we break below that number, the dealer positioning flips to negative gamma.
Which means?
It means the math changes. To stay hedged, instead of buying the dip, they have to sell futures as the market drops. They become sellers.
So instead of a cushion, they become an accelerant. They're forced to sell into the selling.
Exactly. It opens a trapdoor. If 6,850 snaps at the open, we enter a slippery zone. You can see a fast mechanical flush down to 6,730, which is the next structural support. It's not emotional. It's just algorithmic hedging.
That is terrifyingly mechanical. So the bulls have to defend 6,850 with their lives tomorrow.
It is the line in the sand. And on the upside, resistance is heavy at 6,935. That's the zero gamma flip. Until we reclaim that, the regime is sell the rally.
All right, let's get tactical. You've scanned the wreckage and the winners. Give me the high conviction setups for tomorrow morning.
I have two. One long, one short. Let's start with the long. Eli Lilly, ticker LLY.
The heavyweight champ.
Surged 10% today. Closed at the highs, 1,101.1. Reclaimed the $1 trillion market cap.
But chasing a 10% gap up, that feels incredibly risky. Usually we say don't chase.
Normally, yes, but we don't chase the gap. We trade the day two continuation. This wasn't a pump and dump. This was an institutional re-rating. They had a massive earnings beat and raised guidance to $35 EPS.
So the valuation model just changed overnight.
Exactly. And the funds that missed the move today, the laggard funds who are underweight Lilly, they are forced to chase exposure tomorrow. They can't afford not to own it.
So what's the entry? We aren't just buying the open.
No, never buy the open blindly. I am looking for a dip. Watch the 15-minute chart. I want to pull back towards, say, $1,085.
Buy the dip at $1,085.
Target the all-time high at $1,135. Keep your stop tight at $1,060. The risk-reward there is asymmetric. You are betting on the institutions needing to get in.
Okay, that's a long... What's the short?
We have to go back to the scene of the crime. AMD.
You really think there's more downside after a 17% drop? That feels like it's already washed out. I mean, surely the bargain hunters step in.
It feels that way, but the chart says otherwise. The $240 level was support. Now it is a massive overhead supply zone.
Explain overhead supply.
Think about everyone who bought AMD at $240, $250, $260 over the last few weeks. They are now underwater. They're losing money. The moment the stock rallies back up near their entry price, what are they going to do?
They sell aggressive and just get me out.
Exactly. They are bag holders just waiting to sell. That creates a ceiling.
So how do you trade it?
What's the $230 level? If AMD fails to reclaim $230 in the first hour, if it bumps its head and rolls over, it is a short. The gap fill at $215. There is a lot of air below that.
So recap the game plan for the open.
Watch SPX, 6,850. That is your compass. If that holds, we chop. If it breaks, look out below. Watch Google in the pre-market. Does it save the Nasdaq, or do investors use the liquidity to sell more tech? And keep an eye on that rotation into financials and healthcare.
The AI-only trade is under interrogation.
It really is. The blind buying is over.
And remember, don't trust the green on your screen. The bell is coming.
Always.
That wraps up the Wednesday session. We'll be back at the desk tomorrow. Stay liquid.
And stay objective.